2020, which is, I don't know what that was. That's what happens when you turn off the lights. That wasn't a business cycle. It wasn't about inventory or interest rates or anything else. It was just, hey, we listened to a phony like Fauci and shut down the economy. We're going to wake up this winter, although you can see it coming today. We're going to wake up this winter with a severe recession, high unemployment, and a much lower stock market. So far, what I just described is not the same as 2008. We may have a very bad recession, possibly worse than 2008, but just a recession. Now, let's take the financial crisis component, because I said they're two separate things, but they can converge. And they did in 2008. So that was a good lesson because it was as bad as I described. But so then if you want to say, okay, well, what are the odds of a global financial crisis? Bearing in mind that that's different than a recession. Uncomfortably high. So we may end up with both, and this may start to look like not 2020, which is, I don't know what that was. That down 30% in 2 months, March and April 2020, and then up 34% in the third quarter. I mean, what was that? Well, that's what happens when you turn off the lights. And I really fault Trump for letting that happen, but that is what happens. So that doesn't really, that's such a one-off that it's kind of hard to use that as a model. But 2008 is a model, and that may be what we're heading for. The difference is the Fed has absolutely no direct power over the supply side. They don't. They don't drill for oil. They don't run farms. They don't, pilot ships. They don't drive trucks. They don't unload in the docks of the Port of Los Angeles. They don't do anything that could alleviate supply bottlenecks or supply chain bottlenecks. They can control the demand side, even though demand is not the problem. See, this is the point. They can control the demand side by raising interest rates and tightening money, but demand is not the problem. It's not where the inflation is coming from. But if you crush it enough, if you destroy enough demand, it will feed through in terms of lower prices, even with supply side constraints. And just to be a little blunt on the subject, people complain that gas prices went up, and they did. They went from $2.40 a gallon to $5 a gallon or more, depending on where you were. Well, they came down a little bit in July and August. Kind of not all the way back, but maybe closer to $4. All right, that's in the right direction. The old saying, the cure for high oil prices is high oil prices. In other words, the price itself destroys demand. There's a recursive function or circularity to it. And if you want to get the price of gas down, get unemployment up to 7%, because people who aren't working aren't using any gas. It's not a question of having to pay $4 a gallon or $5 a gallon. If you just got fired and you're sitting home, you're not buying any gas. Or very little, and that'll bring the price down. So the way it works is raise interest rates, tighten money, reduce the balance sheet, etc. Get unemployment up. It doesn't sound like a desirable goal, but that's what it takes, and that's what happened in 1982. Get unemployment high enough so people are buying hamburger instead of steak. They're buying, whatever's the least expensive thing on the shelf, or they're not buying gasoline because they're not going to work, etc. That will bring prices down, but at a very high cost, which we just talked about, which is high unemployment and lower productivity. Meanwhile, the U.S. debt keeps going up. That part of it looks like 1981. But if you throw in a global financial crisis, then it starts to look more like 2008. If you ask the typical member of Congress, can you define modern monetary theory? They'll look at you funny. They've either never heard of it or they certainly don't know what it means, MMT, But they're acting in accordance with modern monetary theory. Whether they know it or not doesn't matter. The actual behavior of the Congress, and again, just go back to COVID 2020. Around May or June 2020, Trump put through a $2 trillion COVID relief package, and that was when the Paycheck Protection Plan, that was $800 billion, and everyone got the $1,200 check, and then at the end of December, at the very end of the Trump administration, they did another $1 trillion, almost. And that's when everyone got the $600 checks. And now you're up to $1,800. By the way, those checks, that is helicopter money. That's, what the Fed does is kind of nonsense. But when it's fiscal policy, not monetary policy, and you're handing out checks, that is helicopter money. And credit to Larry Summers for saying, you're going to get inflation out of this. Well, Biden comes into office in January 2021, and he's like, not to be outdone. He did his own COVID relief package. That was another $2 trillion. And that's when we all got the $1,400 checks. They handed them out. And then later that year, I think late 2021, early 2022, they did the trillion infrastructure package. And then, just to top it off, what did we get recently was the just under $1 trillion Green New Deal, or I call it the Green New Scam. And the baseline budget deficit, before everything I just described, the baseline budget deficit was about $1 trillion a year. So take $1 trillion for 2020, 2021, okay, and 2022. Add on, $2 trillion for Trump's first package, $1 trillion for his second one, $2 trillion for Biden's first package, $1 trillion for the Green New Scam, and I think $1 trillion for infrastructure. That's $7 trillion on top of the $2 trillion baseline budget deficit. So that's $9 trillion piled on top of what was at the time about a $21 trillion national debt. So that's how we got to 30 trillion. That's how the ratio went from 106 to 131. These numbers are mind-boggling. MMT says it doesn't matter, but it does matter. It slows growth. You don't get growth. So best case for the US is very slow, weak growth, which we saw from 2009 to 2019. Worst case is you throw a recession on top of that, which we're heading for, and the US will be in fiscal distress. I'll say something that sounds completely obvious, but actually isn't. You want diversification, and everyone rolls their eyes and go, "Oh yeah, diversification. We know that. They teach us that in the first week of risk management or whatever." But people don't understand what diversification is. So I run into people all the time that go, "Hey Jim, I'm highly diversified. I've got 50 different stocks in 10 different sectors. Semiconductors, consumer non-durables, mining and mineral, etc. I'm fully diversified." And I say, "No, you're not. You may have 50 different stocks in 10 sectors, but you have one asset class. It's called stocks. And in financial distress, but bull markets, but especially bear markets, they become highly correlated. Your 50 stocks are all going to go down at once, maybe one or two exceptions, but they're all going to go down at once. That's not diversification. Diversification is having slices to asset classes that don't have very much to do with each other. Not 50 different stocks, but I have a slice of stocks. I'd have some treasury notes for deflation, disinflation, lower interest rates. They'll perform very well. I'd have a slice of gold, but I recommend 10%. People think I say, sell everything and buy gold. I've never said that. I don't think it's a smart thing to do. But 10% gold will serve you very well, certainly as an inflation hedge, but also a hedge against just a collapsing confidence in the money. And that's another subject we haven't talked about, which is, do we even know what money is anymore? Real estate, for sure, not commercial real estate. It's still not off the bottom, but residential real estate, agricultural property, natural resources, water in particular. But, energy stocks have been, if the whole stock market goes down, you might find energy stocks are one of the few sectors going up because the whole Green New Scam, well, let's not even get into climate change, but if you want enough batteries to have electric vehicles in any sizable percentage, not 100%, but just 10 or 20%, there's not enough lithium in the world. The entire world supply of lithium is not enough to build more than a small fraction of the batteries, lithium-ion batteries that you need to run electric vehicles. So none of this makes sense, but it's being pursued by lightweights like John Kerry, Janet Yellen, Tony Blinken. These people are not really serious thinkers. I also recommend private equity, which is hard to find. You got to be really selective. So some equities, a big slug of cash, maybe as much as 30% cash, partly because it's a hedge against deflation, but also people don't understand this. It has embedded optionality. When everything else crashes around you, if you have cash, you're the person who can go shopping. You can actually pick through the wreckage. Everyone else is trying to get out of things